Everyone, to investing in stocks and ETFs. Before we begin, please take into consideration that everything that I'm discussing today is for educational purpose only, and trading involves a high level of risk, may not be suitable for all investors and traders, and you could lose money. So before deciding to trade, please carefully consider your objectives, level of experience, risk appetite, and obviously individual performance depends upon each person's skills, time commitment, and effort. So for those of you that are new to Trade Out Loud, if you guys want to follow us, we are at TradeOutLoud.com, and this is our website. You could also follow us on Twitter, on Facebook, on YouTube, and LinkedIn. And on Twitter, we're a little bit more active. We started being a little bit more active this year, and we are delivering real-time ideas before they happen. So for instance, today we posted a phenomenal trade on Twitter for Disney long that I will circle back to later in this presentation. For those of you that do not know me and they're very new to Trade Out Loud, my name is Anka Metcalf, and I'm the CEO and founder of TradeOutLoud.com. TradeOutLoud.com is 10 years old this year, and we started actually with swing trading and investing service. And it is my pleasure today. I don't get to talk a lot about the investing side and the swing trading side because I'm very solicited for the rapid cash in a flow from day trading futures. But this is something that I have been doing for a very long time. I'm a professional independent trader focused on equities and futures for the last 17 years. So I day trade futures only in the first 2 hours in the morning, and then I swing trade stocks for the rest of the day. And I also invest in stocks. Prior to becoming a professional independent trader, I come with 10 plus years, guess where? In investment banking. So yeah, this is my domain. These are my waters that I'm swimming in. So like I said, I'm the CEO and founder of TradeOutLoud.com. Also run a swing trading service for stocks and for ETFs since 2010. So this is 10-year-old service. And I also run a trading room since 2017. The demand for day trading was very high back in 2015, 14, 15. And I was asked by tons of our traders to come up with a day trading futures course. And I have been teaching futures, how to trade futures since 2015. This is our fifth year. We're wrapping up our fifth year. And we do have a service that we initiated, the trading room, since 2017. We have full performance on our website for swing trades, for active investing trades, and also for futures day trades. We do offer trading education for swing and day trading, and we specialize in high velocity trades, whether we're day trading or swing trading or investing, that we're going to be talking about today. So I just want to get started with your agenda for today. First of all, we're going to take an overlook at investing, because investing can be totally different. You can buy a stock where is, you could specifically, I don't know, let's say buy Apple at the very high. And as an investor, you're looking at the value of the stock more than the technical aspect of it. But I like to look at both. So I'm going to share with you how so I want to share with you how I am investing, and definitely I am an active investor. So I'm not one of those passive investors that just accumulates and just lets the position for tons of years. I like my money to work smart for me. I'm also going to be talking about the difference between trading and investing, investing basics, and what makes a winning trade. So what are the aspects of a winning trade, what we need to look for in order to make money on the long side, on the longer term side. So investing is the process of buying assets that increase in value over time and provide returns in the form of income payments or capital gains. So there are three things that I watch. Number one, I watch investing in stocks. So basically, companies sell stocks to raise money to fund their business operations. Buying stock shares give you partial ownership of a company and lets you participate in its gains or losses. Some stocks also pay dividends, and that's a double ka-ching. which are small regular payments of companies and profits. And we're going to circle back to these dividends because as we're approaching election, we can expect, I would say, more of a sideways market if this is going to be your typical running into election. The month of October is usually a range-bound market. And I'm going to teach you in this presentation how you can capitalize and maximize your gains into this sideways market by investing. Also investing in commodities. So commodities are either agricultural products, energy products, and metals, including precious metals, but also others. So these assets are generally the raw materials applied by the industry, and their prices depend on market demands. So for example, if a flood impacts the supply of wheat, the price of wheat might increase due to scarcity. So buying physical commodities means holding quantities of oil, wheat, and gold. As you might imagine, this is not how most people invest in commodities. Instead, investors buy commodities using futures or even options contracts. And you can invest in commodities via securities like ETFs. So we're buying the shares of companies that actually produce the commodities. And there's also the bonds. Well, bonds allow investors to become the bank where companies and countries need to raise capital. They borrow money from investors by issuing debt. Now, these are called bonds. When you invest in bonds, you're actually loaning money to their issuer for a fixed period of time. In return for your loan, the issuer will pay you a fixed rate of return as well as the money you initially loaned them. So because of their guaranteed fixed rates of return, bonds are also known as fixed income investments and are generally less riskier than stocks. So in general, financial advisors recommend you take on more risk when you're investing for a far off goal, like let's say when young people are getting ready for retirement in their 20s and their 30s. When you have years and decades before you need to access your money, you're generally in a better position to recover from dips in your investment value. So for example, while the S&P 500 has seen a range of short-term lows, including recession, depression, pandemic, it still provided an average return of about 10% over the past 100 years. So if you need the money, but if you had needed the money during one of these dips, you might have seen losses. And that's why it is important to consider your deadline and overall financial situation when investing. Now, let me share with you this chart. This is the S&P. This is a monthly chart of the mini S&P where every little single squiggly candle that you see here represents one whole month of trading activity. And this chart is dating back from the 1990s. You can see it right here. So from the 90s, we had the ascent, remember the dot-com era and the bubbling at the very top in the year 2000. And we had the pullback, right? Look at the pullback, very technical. You're getting the rotation. In 2002, 2003, the market started to recover. Look at the range bound action right here. And the market started to push forward. Now, I know that this may seem odd for some of the traders in here and some of the investors that saw a lot of their accumulated stocks go down in price, but overall, this was just a technical tap into the prior resistance from this prior high from the dot-com era. And this, however, happened that this is when we got our financial meltdown. So the price here revisited the prior support zone from which it rotated back in 2000 towards 2009 when the recovery started, and the price started and never looked back again. So basically we have a double top and a double bottom formation. So basically resistance resistance and support from which we have bounced higher. So no drama here. And I know as dramatic as 2008 was, it was not as dramatic if you were an investor, because all you had to do is wait for the dip and accumulate some more on any sign of technical rotation that will punch the price higher. What this ad would do for your investments, it would actually bring your average down, because remember that if you were in your 20s or 30s or 50s or even 60s, and if you decided because you saw the market recover from the dot-com era and you say, hey, in 2007, I'm going to be a buyer right into this very high rate here because I think it's going to break above the high and it's going to continue higher, right? So that would have been an option. And for those that were very aggressive and just opened an investment account and said, hey, I want a piece of action, I want to buy some SPX over here, that's fine. Or even any stock, that's fine. But don't forget, whenever you're investing, don't put your eggs, first of all, in one basket. That is rule number one. And rule number two, always scale into trades. So don't invest your whole entire account into one position or into if you're trading one position, make sure you leave ample room to add to your existing position. I typically use, for investing, at least 8 lots for my trades, because on every single dip, like I said, I like to actively invest and I want to work by trade out. That doesn't mean micromanaging my trade, because I'm trading on the investing side. So I may revisit it in a couple of months or even 3 months or even quarterly. So basically here, if you were a buyer at the very high, don't stress. As soon as you see the pullback, rotation, add some more into your trade. And why is that? Because you're going to get a much better average. You don't have to wait until the price recovers completely 100%, because then you would have to wait about 3 to 4 years until it challenged the prior high. But if you want to learn how to manage it correctly, this is something that I do, and I have done it into my investing years. I have done it while I was, working into investment banking, etc. So this is something that we look for, even if let's say we have a high, when we have a dip and a technical rotation, we added. So at this point, if you would have taken the high, added at the low, your average is somewhere in the middle. So you would have recovered and be in the profit sooner rather than later. So you would be in the profit in, let's say, 1 year or a year and a half, or even maybe less than that. Instead of waiting 3 to 4 years. And you can see here that every single time when we look at this chart, we see that you have a plethora of trading opportunities and adding and reducing along the way. And these are incredible, profitable strategies for the investor. So the ad that came into the bottom, lifted back up, rebound and coiled into the 200 SMA. And here it coiled into this area in 2010 for about 4 to 5 months. And then before the liftoff, then we came back in. This is another rotation that is happening at around the same level with another possible ad. And every single time that you see here, you could have a plethora of ad opportunities, of investing opportunities along the way. Now, this is the 2016, and this is, and by the way, 2016 was a very, very choppy year. And but also that I want to share with you something here on the chart. Look at the volatility. These were years right here from 2009 all the way. And the first volatility came in really close to election in 2015 to 2016. But from 2008, actually 2009, and all the way to 2015, we have had almost zero volatility. So we had very little volatility. It was just a steady grind into the market. The first volatility came in here. 2015 and 2016 were very difficult years to trade. And of course, the easy trading came right after election, when the market rampaged to the upside and it followed the trend. Beautiful move. The first spike into the volatility came in 2018, and actually first time around was in February. Then we navigated quite safely throughout spring and summer, and then bam, we got hit really hard in October, November, December, which typically represent the best 3 months for swing traders and investors to have some really great opportunities line up in the market. And that is when the market just pulled back really, really hard into those 3 months. Typically, those 3 months are always to the upside into the market. And then again, here we had the pandemic. And of course, these are events that cannot be controlled, but look at the market recover. So basically, if you were an investor back here, that where we mentioned, let's say in 2007, and if you said, hey, this is where I'm going to get in, there are two things that you can approach this. You know, you can just let it ride, of course, and you can see that from 1,500 right now, you more than doubled your stock price. Or you can actively manage it in a couple of months, or every quarter you can manage your positions and look for opportunities. Now, how long do I keep an investing position, right? Well, stocks, bonds, and commodities trades will be held from a few months to a few years, or even more, right? Decades. It focuses on higher time frames. So when you're doing your chartly analysis, you have to focus on your weekly, your monthly, your quarterly, your annual charts, and so on. And obviously, those are for very long-term investors, the annual charts. So active investing, and there's a different way to approach investing. Like I said, there's the traditional investor where you get in and you just forget you have that position on. And you're looking to bank profits in a decade or 2 decades from now. And of course, there's the active investing that I am completely 100% involved in. Active investing is when a trader or active investor takes advantage of market dips and initiates key positions at key times and key locations, or simply adds to the existing position, like I showed you in the prior slide. The active investor is more of a hands-on investor, but that doesn't necessarily mean that you're going to be compulsive like a day trader. No, you're just going to look at the bigger picture. You're going to look for fundamentally sound stocks like Amazon, like Google, like Nvidia, or Microsoft. These are fundamentally sound stocks. And you're going to look to follow a certain trend, massive trend to the upside, right? So you're going to look to see how is the chart structure on all of these higher time frames, and you're going to look for pullbacks that are going to enable you better entry opportunities, because the advantage is that it's not only like for slow term growth, but you want to have a growth when it comes to a little bit more, I would say, active growth, because you're going to buy it at that key location. And plus, you're going to have, you know, you look also, something that I like to look for is high paying dividends, right? Because that's extra income. That is actually the bonus. So why is that? Well, if a stock pulls back and the account is not growing for a couple of months, you still earn the income. Because remember what I said, that around election time. So this typically is like a month into election. So that would coincide with the month of October. We're not very far apart. We're very far from that time. So we are just about a couple of weeks to 3 weeks away from that specific time. So when October comes, and if you're going to notice a sideways range in the market, but if you are positioned, even with a swing trade, as long as the market is not taking out your stop, let's say if you're in a long position, you can be in that position for a relatively long period of time, because as long as the market is sideways, you're committed to that trade. There's no such thing as, oh, I'm going to take myself out of the trade because I'm bored. There's no such thing. So as long as your stop is not being violated, or the area where you think that is your cutoff line, you're still involved into that trade. So when it comes to investing, you have to choose wisely. So this is a chart of Apple. Okay, so you can see here that Apple, Apple is basically a buy off of any type of pullback and on any kind of pullback. This is 2016. You can see how in 2016 it started to ride the 10 EMA. It's all technical, by the way. So if you marry technical fundamentals, you're going to have great results in your account. Look at the pullback here. It came to the 50 SMA. 50 SMA is very friendly for the investor, and it's also very, very friendly for the swing trader. You got your rotation, the price goes back up. So here's the thing with investing and with active investing. You can leave your whole entire position in, number one. Number two, you can actually exit at any kind of rotation, at any kind of exit, at any kind of big push to the upside and rotation back to the downside. So you don't necessarily have to live through pullbacks, because here, if you started the position in 2016, you would have exited the position in 2018. Right here, this would be the candle where you have exited the trade. And then you wait calmly for another rotation to happen and for the price to go back up. And you would easily see that during the pandemic here in February would have been your out zone. So you don't necessarily have to marry the trade and stay into that trade forever. You could actually take advantage of these market swings and pullbacks that are happening on higher time frames. And this is the monthly chart. And if you can see here, this is the first inside candle that we had from the volatility bar in March. And this was a very clear entry signal for active investors to ramp up higher. Now, the question would be, hey, am I still holding Apple if I'm an investor? As long as you don't see any kind of rotation that is happening off of the monthly, yes, you are still an investor and you still hold the stock. So is investing the right option for you? Okay, many traders have different goals and different account sizes, and I could tell you right now that a lot of traders are not comfortable with holding positions that much far out. Maybe you're in your 60s or 70s or even into your 80s, or even if you're into your 40s or 50s but do not have that risk tolerance, and you want to have access to your cash, let's say every 2 weeks or every month or at the end of the month, then swing trading is for you, because swing trading is the sweet spot between day trading and position trading. So that means that this is a really great opportunity for you to take part in the market moves, like the real nice swings to the upside and also to the downside. Because if you're not trading let's say a retirement account, and if you have a brokerage account, you could take advantage of the positions where you can short the market. It generates high probability trades and it offers the best chances of success. Why? Because you have access to cash. Like I said, at the end of the month or at the end of the quarter. It brings you more cash in, because at any signs of reversal, you're basically taking your profit and you're looking for the next buying opportunity into the market. Okay, so swing trading positions can be held, you guessed it, from 2 days to a couple of weeks. Swing trading is focused on capturing the momentum into an up or downside without having to live through the pullbacks. So there are swing traders that love to hold their pullbacks, and this is actually advisable when you have a real dominant trend. And it focuses definitely on higher time frames, but trades can also be taken as close as the hourly charts or even the 4-hour charts. And also, obviously, your homework piece is going to be executed on the daily charts and onto the monthly charts. Now, these are some personal investments. There are opportunities throughout the years. Not every year is the same, but there are opportunities throughout the years when you're actually going to see a much more mass accumulation. And this mass accumulation for me and this investment account was back in 2016. I mean, look at the parade of the trades that I initiated in 2016, and you can see them right here. So, and basically look at the returns that we have and I have into these personal investments. Now, this is long-term money that actually I do not touch, okay, that I do not touch. Do I look to add to these positions? Yes, I look to add to these positions. And these are positions that I don't micromanage. So I leave these on for years, okay? So I look for long-term growth into this account. And you can see here, this is my pride and joy NVIDIA, and you can see NVIDIA right here initiated the trade on March 1st, 2016. Remember what I said, 2016 was that year where that consolidation year. It was a year, end of 2015 and 2016 was a really great breakout zone into the market, and I still hold the positions now. So $32.30 is where I bought NVIDIA. Obviously, now with the Apple split, I have more shares of Apple. The more, the merrier. The cost, I bought it at $99. It ran to $400. Don't forget, now it's back. 41 split is back into $100. At any pullback, I'm going to look to buy some more. Look at the Qs. I purchased the Qs at $100. Does anybody know where the Qs are trading right now? Well, they had a high last week of 303. Also have COP, and I still have a little bit of losers right here, like EOG. Some of the energy stocks that were, you can see it right here. I have one energy stock in particular, this EOG, that is weighing down a little bit, but that doesn't matter because the overall, look at the overall image right here. I mean, literally, I have only 3 that are down in an ocean of green. All right, so who is swing trading for? Well, traders with busy lifestyles that want to manage their long-term money, or trading accounts. Part-time traders that do not want to sit in front of the computer all day. Swing trading is the wealth generation styles of trading, just like trading and just like investing. And all you need to do is to manage it is about it's about 10 minutes a day. And of course, you need to do your homework. If you want to learn how to do it, you need to do your homework at the end of the week, and you have to scan through some stocks, look for some trading opportunities to see where you're going to put your money. Because remember, your money is working for you. It's great because you can work from home, make a living out of it, and obviously you make your money work for you. So your charts and your stocks become your employees. Now, your investment account should be separated from any kind of short-term or even medium-term account. So if you're day trading and swing trading, you should definitely have all separate accounts, and investing all separate accounts. So if you're doing the 3 options, you should have 3 accounts. Day trading should definitely be way, way, way apart from all the other accounts. So divide your money however you please, but make sure you have separate accounts, one for day trading, one for swing trading, and one for investing. Because if you are doing your investments into your day trading account, you're going to literally start micromanaging, because you are going to have your day traders hat on. And if you see a pullback on a 5-minute bar, bam, you're going to go like, man, this is going to be, you're going to take yourself out of the trade. So these are the 2 investment accounts that you can have: brokerage account or retirement account. There are a plethora of other, other types of accounts, as well, education accounts, college accounts, etc. So you could do your due diligence on that. So let's talk a little bit about investing basics right here. So determine, first of all, what is the one thing that you need to determine? Your time horizon. What kind of trader are you? Are you a medium term trader, in which case you want to have access to your cash a little bit earlier? Let's say in 2 weeks or 3 weeks. Let's say you had a long in Tesla, you took your profits from Tesla, and now you want to go buy yourself a car, right, with all the profits that you made. So this enables you to have, let's say, somewhat of an, I would say, an income. But if you want to grow your account, leave your profits back in, and all you have to do from now on is just take more positions. Because definitely your account has grown, and you can actually increase your risk per trade. So it's actually going to generate you more income if you look at it longer term. So also, you can look at long-term investing, whether you do active investing like I do, or what you do in my other account, like long-term investing. Like I don't want to touch my my account, like, let's say, in 10 years from now. So you have to decide what are your realistic expectations. And I know that a lot of traders are here right into the swing and also into the active investing arena. The other thing that you need to consider is, what is your risk tolerance, low risk tolerance or high risk tolerance. And remember that it's it's actually great to have a lower type of risk for your trades, because this way you're going to manage the trades way better. It's different than day trading. So what to look for in a stock? Definitely, to identify winning stocks, you need to pick them at the right time and at the right location, so you can double up of all the benefits and you can collect all the profits from it, whether it's dividend as well as progress from the trade moving up, or if you're a swing trader, you could collect money as the price is going down. So how to select these winning stocks? Let's see. Well, first of all, it takes a proven strategy to select winning trades or investment. There's a scanning process that is involved. You have to analyze the market. You always have to be in sync with the market. what the market is doing. By the market, I mean the Qs, the SPYs, the diamonds, and Russell, right? So you have your 4 market indices. You have to determine what is the relative strength, what is the relative weakness, what is the dominant trend, what are they doing. Based on the market indices, then you go and sort out your sectors and see what sector is leading, what sector is lagging, and what is the performance. You know, you want to pick something that has relative strength and compared to the market action in a very strong market environment, because you don't want your stock to be dormant, right? You want your money to work for you. And if you're looking for stocks that are stronger than the actual market environment, you are going to see that your trade is gonna run faster to targets than any other stock, right? Than a lagging stock. So in strong markets, you're going to pick very strong stocks. And in a weak market, you're going to pick very weak stocks, so they accelerate to targets faster. The stocks need to be fundamentally sound for long-term trading. If you decide longer-term trading, they have to be very fundamentally sound. If you're swing trading them, no, you just, you basically get in, get out in 2 days to a week or 2 weeks, and then you're done. But if you want to invest, you want to make sure that you are investing in a fundamentally strong stock and you do your analysis on it. So if you want to invest in Amazon, by the way, Amazon, if there's one stock that you're going to trade till the end of time, it's going to be Amazon. Amazon is going to be here. Amazon is a monster. Or Google or Nvidia. These are all stocks that are going to be around for a very long time. They're fundamentally sound. Even Apple, Apple is very strong as well. So fundamentally strong stocks are the way to go. The other thing is that you have to match the fundamental with the technical. So yeah, I found, let's say, Google. That doesn't necessarily mean that if you find a fundamentally sound stock, you're going to jump in right away. Yeah, if you do not want to look at charts, and if you call your broker, if you're very busy, and say, hey, I want some shares of Google, I want some shares of Amazon. You don't care where the price is trading, because remember, and by the way, Google doesn't pay dividend because everybody wants a piece of Google, right? So you have to choose wisely, because if Google price goes down, remember, your account is going to go down with it. And you have to pay attention at the technical rotation, because your financial advisor, your broker is not going to tell you, hey, this is not time to buy or sell. No, you tell him to buy it. That's what he does. He buys it. But what happens when you line up strong fundamental with strong technicals? Now, this is that boom that is going to create cash in your account. Your account is going to grow very fast because you're marrying technicals with fundamentals. So now that you know that you have identified fundamentally strong stock, you got to wait for that really right pullback area. And from that technical rotation, that is really going to take the price higher for you. And this is how you have these winning stocks that you make money in them right away. And this is the active investing style of trading. And also buy stocks that are on sale. Don't buy them in the very highs. Don't be an Nvidia buyer at 589. Don't be a Google buyer. Let's say last week it had a high of 1726, or an Apple buyer at 137. Wait for the price to become more appealing for the buyers to step in. Now, when you go shop for a car, you go to the car dealership and you see the sticker price, you have the MSRP price right there on the dashboard. And do you really want to pay that price? No, you go inside, you talk to your the sales representative, and you're going to ask, what is the best deal? I have a Costco program and I got this email. Am I going to get a discount on this? Or I'm a GM employee and I want to get a GM employee discount. You're always looking for a discount, and same with the stores. Once a product comes out, it's fine. You can buy, like I said, for investing purposes, you can buy it. But you want to buy it with a discount. Doesn't it feel better when you go shopping and when you see the yellow tag, clearance tag, or the red sale tag, or some kind of sale tag? Same thing with stocks. Buy them as support if you want to take them for long, right? So when to buy? When certain events happen, right? So these events create pullbacks. The pullbacks that make the share prices go lower to a level that becomes very appealing to the buyer. So what are these events? Remember we talked about when we started with the SPX chart of the monthly chart of the SPX, the dot-com bubble, the 2008 financial crisis, the 2016 election. And remember that year was incredible to buy because it was such a range-bound year. And this is what I did. Or the 2020 pandemic, right? 2020 pandemic, remember, it was the sharp decline. Just wait for some technicals to line up and boom, there you have it. So do I need these events literally to get in? Well, yes, I would wait for them. But no, right? And no, yes and no. Make sure that you leave room to add on any kind of dip if you're buying the high and if you want to be an investor. And you want to focus on the companies that have thrived and survived over the years, and you have seen really nice bounces off of these levels. And also be very diversified. Don't put your eggs in one basket. Let's say if you're looking at financials, don't just go along and buy, let's say, JP Morgan, Goldman Sachs, Bank of America, and have just a pool of financials. You have to be incredibly diversified. And stay away from high-risk industries like airlines, hotels, biotechs. And by the way, the airlines, the entertainment, and the hotels today are really, really strong and holding us. So those make it very appealing for swing trades, but not for investing side. So let me share with you some types of stocks. We have growth stocks, value stocks, income stocks, blue chip stocks, and penny stocks. I'm going to start with the penny stocks. These are inexpensive, but very risky speculative stocks issued by companies with short or erratic performance histories. Their low prices nets a small loss in exchange for the potential for an explosive growth. And I'm going to share with you a penny stock that I bought in 2009 that is going to blow your mind away. And I love researching for these stocks. Also, the blue chip stocks. These are stocks of large, well-known companies and with good reputation and strong records of profit growth. They are considered safe investments as they generally generate dividend. Whenever you see generate dividend, and I'm going to share with you 10 high dividend stocks today, I'm like, my light bulbs go off, and I'm like, yes, extra income. That is a bonus. And you also have income stocks, generally not expected to appreciate greatly in share price, but typically pay steady dividends. Utilities are an example of companies that have historically been considered income oriented. And then you have value stocks, those of companies with growth potential that are currently selling at low price relative to their intrinsic value. It can take time for their true value to be reflected in their price. And last but not least, bam, the growth stocks, usually in new or fast-growing industries, and have the potential to grow to give shareholders greater returns. However, they are the most volatile class of stocks and may be just as likely to go down in price. So again, you have to do your due diligence. The way I look at the market when it comes to trading, I don't have a crystal ball. I do just tons of research. And tons of research on the fundamental side, tons of research on the technical side. Technical weighs more in my balance. I am a 90% technical trader and 10% fundamental trader. This is the stock that I mentioned before, the penny stock. So you can find some really good gems. And for me and for my account, especially in 2009, saw an explosive growth with the selection that I've made, and that is because I do my due diligence. Now, 2008 was not very generous to any stock in the stock market, and you saw like a big hit and everybody took a big hit. Back in 2008, Sirius Satellite did not have any competition. So therefore, when the stock dipped down, and look at this base right here, it base for 1, 2, 3 months. You can see it right here. So for 3 months, it has not done anything. I mean, what was my risk on this trade? Literally zero, right? So you position size for 0. I picked up the stock at 0.27 cents, 0.27 cents, and I sold it. You see this red bar right here? I sold it right here. This was me out right here. So I went from almost 30 cents to about $6.50. This is where I exited the trade. And then it started pulling back again. You see this technical rotation. Now take a look at the technicals of this chart. Very interesting. So devote time to your analysis. You know, just get yourself a glass of wine and get your platform ready. And look at the price action. Every time the stock has revisited the 50 SMA, it became incredibly appealing. So guess what? On this technical rotation, I bought back again. I had a signal to sell at the exit. I had a signal to sell at the rotation point from the high. You see this rotation point right here? And we didn't really have steep rotations because we were already trading off of the Magnet 20 here. But here we had a rotation. I was out again, just below $7. And I'm actually looking at it again because if it trades over $6 again, guess who's going to be in this stock again? Moi. Okay, so again, a really beautiful, beautiful stock to be in. This is NVIDIA. This is where I purchased it right here in 2016. Look at the really nice trading opportunity. It had done nothing from 2011 to 2016, and then finally a bit bleeped to the upside in 2015. And then on the next poll, I'm like, this is mine. Okay, so there are multiple opportunities. I have this for the long-term growth, but definitely this was an incredible ad opportunity. You could have got exited here and an ad opportunity into the 150s to 175, and look where it is trading right now. Boeing is the one to watch. Boeing has not done anything. It's still under a lot of uncertainty. But hey guys, it's Boeing. Look at the nice hold off of the 200 SMA. And if you think you may be late to the game, no, you're not. I think the stock is just setting up. And look at the 2015 to 2016. Remember when I bought the bulk of my stocks? It was right here. So it's not trading that far away. So Boeing is going to be on my watch list in my portfolio. Now, I want to share with you the 7 best growth stocks for 2020. And this is what I have on my list. If you're considering swing trading or active investing, any pullback into these stocks they're going to provide with very good returns. And this is Amazon, Facebook, Google, FVRR, Work, Microsoft, NATVI. We don't have a lot of time to dedicate to charts today because I do have tons of other information that I want to share with you. We're not even halfway at this presentation. I also want to share with you the 10 high dividend stocks. I want this to be like a flash course on investing for you guys. So IBM pays a dividend 163, Home Depot 150, CM, this is a Canadian company 146, 3M, by the way, 3M producing masks as well, 1.47%, UPS $1, BMO $1.06, Duke 97 cents, FedEx 65 cents, Verizon 62 cents, ETR 93 cents, and the list goes on. You just have to do your due diligence. These are some of the trades that we executed into the swing program, so you can make great money in a short amount of time. You don't have to wait decades to make money, but it all depends on your objectives. These are just some trades that we have done. I'm just going to fast track through them very, very fast. Also the VIX as well. You can take advantage of the VIX, the volatility index, which by the way is rising right now. Home Depot, again, this is a high dividend stock. So these are institutions that exited the stock, and the stock you can see meandering right here. Roku as well. These are great swing trading opportunities. And by the way, right here at the bottom are the alerts that we send to our members. Now, swing trading and investing training 101. Let's talk a little bit about entries because I did mention the pullback. So what do you need to look for? You need to look for very good entries at key locations. So what is an entry? It is an early point within a potential leading stocks consolidation or reversal from a correlation pattern, a buy pocket. So when you have the price going back and rotating, it creates a little pocket. So that buy pocket is also called the buy setup. And it's a continuation of a buy point for a leading stock that is already firmly formed in a very strong trend. Because remember, when you trade, you need to select stocks that have that are into very, very strong trends. This offers both a way to get on board strong leaders later on in their uptrends, as well as extremely reliable and powerful tool for adding to positions. And this is something that I like to do. Initiated earlier when a stock was still within or just emerging from its original consolidation or reversal pattern from the correction pattern. So learn how it's done, and this is going to unlock the kingdom to your account profitability. The skill is going to last you a lifetime. You don't have to rely 100% on a service. You just learn how to do it, and you do it, and you trade. It's a recession-proof skill, and you can profit from a recession just like I did from any kind of recession. I profited from the dot-com pullback. I profited from the financial pullback. I profited from the pandemic pullback. So there's a lot of ways in which you can profit long-term or shorter term. And the best thing about it is that you don't even have to leave the house in order to trade. You can make money while other individuals are just waiting for their stimulus checks or unemployment. You can thrive. Now, I'm going to share with you very quickly, and these are very important for you to mark down. These are 10 ways to generate income swing trading at the end of 2020. These are things that you need to look for. Number one, let the chart do the talking and guide you through the trade, and you have to be very patient for the patterns to line up. You have to pay attention to the technicals, patience to wait for the pattern and the risk level. Select the proper time frame for each trade, whether it's a short-term swing or medium-term swing, or if it's an investment position. Don't overthink it. Why do I say don't overthink it? Because the patterns have to be very evident on charts. If I show you a chart right now, that setup is going to have to pop up immediately, because remember, trading is very visual, and visual memory, right, is the way to trade. Because when you remember winning patterns, your brain is capable of recognizing those winning patterns. And if you don't recognize the winning pattern in the first second or 2 seconds, don't try to micro analyze it. In fact, when I scan, I dedicate probably 2 seconds to every chart, because I go through about 6,000 charts every weekend. Yep, that's what I do on the weekends. I scan through over 6,000 stocks. So that's the pattern has to be very, very evident, so you don't overthink it. Because if you're overthinking and say, hey, but this bar, but that trend, but this time frame, but you know what? The trade is not there. You're trying to force the trade. And you have to become a very good technical analyst, okay? You have to keep it simple. Look for relative strength and relative weakness. This is what I preach every single time, because you need to be in sync with the overall market, and you have to select the stock that is stronger than the overall market or weaker than the overall market to accelerate into targets in order for you to get those high velocity trades. That's the whole secret. And if you know how to identify that, then you're going to have explosive moves once the trade triggers. Obviously, don't try to fight the trend, and don't be stubborn. So remember, take your losses. There's no, nobody's going to, hold you accountable and say, hey, you did that. No, don't be stubborn. So take your losses and then move on. You're going to see a great pressure. You're going to see that, heavy pressure once you exit the stock that you have been in and it's under, and it has reached your stop level. It's like pressure is off, right? My 1-point game plan. Well, here's it's actually a 10-point. It's not a 1-point game plan. Zooming out to the bigger image, to the bigger technical image, regardless whether you're an investor or a swing trader. Focus on trend trades. Like to trade the runner-ups into trading, into earnings. Do not hold swings into earnings. If you want, you could do option lottos for that, but don't hold common. I rarely do that. I'm not going to say that I never do that, but I rarely do that. Zoom in on tech. And by the way, don't hold swings into earnings. But listen, if you're in investing trades, definitely you just hold your positions, because you're looking at a much higher time horizon. Don't overthink it again. Establish trading parameters. Also have a precise trailing plan in place and how you need to act at key locations and key levels. Remember, targets are still targets, even if you are into investing trades. look at the projected targets. Even if the stock is trading at all-time highs, there are measure moves that institutions look for, where they are going to ease out of their trades and before they start the accumulation process again. Assess the odds, the risk, the position size. Oversizing always is creating a lot of pressure for you, and ultimately it leads to mismanagement. And always scale into targets, and always take some, a little bit off into each and every single target. Now, here are my 10 golden rules for investing. Number one, associate and analyze the environment. What kind of environment are we trading in right now? And obviously right now we are trading into high volatility environment. So always, this is great to take into consideration. You may want to, when the markets are moving really fast, you may want to take the back seat. You may not want to get into the market right away. You want to check seasonality, because there are certain types of trades that work on seasonality. So even the SPX or NASDAQ, they are trading into a cyclic seasonality. Pay attention to earnings. Obviously, if you're a swing trader, always be diversified in everything that you do and every trade that you take, even in swing trading. Like I said, don't put your eggs only in financials or only in tech. Always look for the sector rotations and always have a diversified portfolio. Follow the overall market and industry group. Pick your relative strength and weakness. Again, and you can see here, these are really great rules. Do not get out of a good trade just because it has hit your target. Always let the market take you out. So have a really solid management system behind your trade, and trade like a professional. Don't get freaked out. Oh my God, yeah, I'm so happy, reached my target, now I'm out. Huh? No, you have to make sure that you know how to trade it professionally, just like hedge funds do it, just like institutional traders do it, because 90% of the time, traders leave most of the money on the table when they take themselves out of trades. Also, multi-time frame alignment, they have to be in sync. So it's very important that you need to respect the trend, the overall trend on multiple time frames. And also be aware of volatility, because volatility just hit the market right now in a really big way. 6 technical trading rules. Now, trade stocks and ETFs that have relatively high volume. So how do you select your pool of stocks? I like to trade something that is really high volume. I just don't even look at stocks that are trading 200,000 shares, 500,000 shares a day, or 800,000 shares a day. No, I look for really heavy volume, at least 1.2 million shares on a day-to-day basis. And obviously trade stocks that have a pattern of beating earnings, you know, like Apple. Apple underestimates and over delivers always. Next earnings season in October, just watch Apple. And remember what I said, ideally to trade stocks that are already above the 20 and the 50 SMA, technically speaking, on higher time frames. Look for confluence levels on zone and watch left-hand side price action. This is a key, because if you watch left-hand side price action, that's your crystal ball right there. It's going to tell you not exactly, but it's going to give you the ballpark of what the future price action is likely to do with I would say with about 75 or 85% correctness. Stocks and ETFs, like I said, you know, at least 1 million shares a day. Sharp pivots have an increased risk of failure, and then look for more rounded bottoms and consolidations. Those are a little bit better when you're swing trading. Now, what differentiates a successful trader from an unsuccessful trader? Well, successful traders are educated, and most of all, they do their homework. Lazy traders are not going to make it in this industry. So you think that, it's Labor Day, I'm going to take the 3 days off, I'm not going to scan, I'm not going to do anything, and then I'm just going to hop on Twitter and see what everybody's trading, and then I'm going to hop in some trades. It doesn't work like that. It may work like 1 day or 2 days, but that is a recipe for disaster. You got to be educated. You got to put in the homework. You got to be prepared. You got to mitigate risk and know how to mitigate the risk. You have to learn from the failure. It means when the trade stopped out, take a look at why did it stop out? So look at to analyze it, because that's how you understand it. Was it your fault? Was it the market's fault? I mean, what happened? and always adapt. The markets are ever changing. We saw a huge shift in the market in 2018 when they introduced more algorithms to the market in London, and also into the US in September of 2018, and the market has been totally different since then. Believe in accountability. Well, unsuccessful traders, they're not educated. They wing it. They ignore the risk, repeat their failures. They don't care. It's like, oh, okay, I stopped out. Don't worry, tomorrow another day. Okay. They don't adapt, and they believe in randomness. Now, how you can turn about an hour a week of trading into 5, 6, or even 7-figure trading account size on weekends, and you do all the research, and that 1 hour you spend it on weekends. Scan. Find a pool of stocks. You don't have to go through the 6,000, but find a pool of stocks of, let's say, 50 stocks or 100 stocks that you want to watch. 50, I would say 100 is a bit overwhelming, especially if you're at the beginning of trading. But find some stocks that are definitely, excuse me, that are, definitely, that represent good fundamentals, strong trends, and just scan through those 50 stocks every single week. And I bet you're going to find really good trades. So in an hour a week, you can dedicate to your charts, and you can really, really advance and fast track your trading. Now, here's a checklist. Get your education, fund your account after you have the education, have a trading plan. It's very important. Do your homework, execute, never chase. Mind your risk, position size according to your account size. Remember, a very little goes a long way. Trail into targets. Don't take yourself out of trades. Don't be that amateur that sees the target and sees green in front of his eyes and say, oh, I'm taking target right here. Okay, no. Let your winners run and cut your losers. But also be very mindful about these losing trades, because these losing trades, you have to do a lot of analysis, and you take yourself out of a losing trade only when you breach your stop, so that you stop out at a stop. I have traders even in the trading room that, they message me and they say, okay, so, I took myself out of the trade, and I'm like, why? It hasn't hit the stop yet. I mean, why take your, I couldn't take it anymore. I just wanted to get it over with. That is a loser mentality, because you need to stay in the trade as long as, and then again, that specific stock or index or whatever we were trading, guess what? Turn around and ran into targets. Just because you're bored doesn't give you the right to take yourself out of the trade. So let's talk a little bit about the results here. These are my results. January over 49, not a losing month. Take a look. January 49.54%, 11 trades, 59, over 59% in February, March 58. Look at April, 71, May 43, June 104, and August is just off the charts. For complete performance, you could click here on my website when you go to the Swing Trader program. All profits and losses are calculated based on the price of the stock or the ETF at the time the alert went on, right, at the entry price. And the losses are calculated, obviously, at the stop loss level. And the trade, basically, if it ran from the entry price to the trail price, not to target 1, 2, 3, to the final trail price, that was sent out to members, and that is what this measure represents. These are August was off the charts. I mean, you can look at these trades right here. We have very few losses. In fact, in the first part of August, look how active it is. And by the way, in March, we only have 4 trades. And you can see it right here, that 13%, 5%, 3%, 3%, 17%. Take a look at this stock in SQ right here. 6, 3, 6 again, 3, 2, 5, 3. And this is just beginning of August. We continued with, look at these numbers, guys, 31% in VPAC. This is a smaller price stock. VPAC was a great entry opportunity here. By the way, if you see 100% here, the trade is still active, so it has not stopped out. So that's why we have the 100%. You can see right here, like a small loss of 2%, et cetera, et cetera. So basically, and by the way, this is still August right here. We still have open positions in these trades right here. This is a gold trade right here, which is working right now. Okay. And September, we had 1 loss in Cisco right off the bat. You can see that we killed it. We had a stop at under $41. Actually was 10 cents under the whole number. We took a loss, so on, move forward. You saw the winners that we have. I mean, hello, it's a little loss there. Losing is part of the program, but is part of the plan. But when you have these winners, okay, JP Morgan, Bank of America, and Boeing hit targets in less than a day, and actually one morning. And we have Disney that we opened today. And Disney is a trade that we opened today. I'm just gonna share with you. This is Disney right here. Ta-da! And it hit targets immediately. All right, so if you have the desire to make it trading and make trading work for you, obviously, and make your money work for you, you want to change the pattern that you are trading in right now, I can definitely work with you. We could teach you our system, our swing trading and investing system. And if you want to achieve, you know, above average results, just like you just saw, we do have a course. It's called the Wealth Generation Swing Trading and Active Investing course. We only teach this course once a quarter, and now we're teaching it in October. And the next one is going to be all the way in January. So good investing begins by investing in yourself. Invest in education, do the research, and then decide your investment. Now, this course, you're going to find out more details if you click on TradeOutLoud.com/swing trading. The course is live October 5th through 9. It's Monday through Friday. It's about 2.5 hours every single day. So don't make plans after 4 o'clock. And you have free access to the Swing Trader until the end of 2020. The course tuition is $6,997, but we have an early bird special with $4,995. So we slashed $2,000 out of this. And the deadline is September 11th, 2020. So if you're interested, hop into the website, find out more about it. Thanks so much, David.